Today on Expedition Retirement, we're going to answer the most common question we've got so far this year. Where do I put my money? We're also going to talk about how annuities really are the class nerd. So who's the class bully? Next, we'll talk about CDs versus annuities. What is the right choice with this interest rate market? And finally, we'll talk about how much do my investments really cost? Or better yet, how do the people selling them get paid?
Welcome to Expedition Retirement with your host, Greg Aler, the attorney and CEO of Golden Reserve, a financial retirement firm whose focus is helping retirees navigate the boulders of getting down retirement mountain safely. Greg is also a popular radio show host. And now it's time for Expedition Retirement.
So the number one question we hear all the time from clients and viewers are like, where do I put my money now? There's a lot of options out there, right? Stocks and bonds, gold, mutual funds, ETFs, CDs, annuities, money markets, and now even crypto. Lions and tigers and bears, oh my. I mean, really, oh my. Seriously, I'm having flashbacks to Dairy Queen in the summer weighing all my options. Dip Coat, Dilly Bar, Chocolate Fudge Sundae, or the good old Blizzard. But if I get a Blizzard, I now have another 47 candy options I have to choose from. All of a sudden, I just blurt out, Peanut Butter Parfait. What? I hate peanuts, and I have no idea what a parfait is. My point? There are hundreds of investment options and hundreds of different types of financial advisors ready to sell them. And most retirees are bullied into buying investments that just don't make sense, just like my peanut butter parfait order. I know, your guy or gal is different. You have the genius who guesses right every time. Sadly, most people think their financial advisor is doing research, evaluating the market, getting in and out of the market on your behalf, day to day, hour to hour, all while chasing a new hot stock tip. It is complete BS. Nobody, and I mean nobody, knows where the stock market is going. I mean, think about it. Your financial advisor probably has hundreds of clients. So you're getting the exact same amount of attention and many times the same exact plan as everyone else, which probably isn't much attention at all. Real talk? Picking the right investment at the right time is impossible. If someone does it once or twice, it doesn't make them a guru. It's just the law of probabilities. A broken watch gets it right twice a day. That doesn't mean the watch works. We emotionally overattach to the wins and forget the losses almost instantly. That is really our coping mechanism when it comes to losing money. Under the rug it goes. I know it's hard with every financial advisor on the planet selling risk, that you need it. You have to make a certain return, or the retirement grim reaper will take your house because gas and milk prices are a few more bucks a gallon. But before you sign off on those risky investments, do some math for me. What income do you get in retirement and what expenses do you have? Throw in some fun money. How big is that deficit? I bet not very big. And if you multiply that by 20 years, it's still probably smaller than your nest egg, right? That means you won. The game is over without making any interest or gains. You won the retirement game, and that's pretty awesome. No amount of inflation, cost of living, or other jargon can cover up that most financial advisors' math just doesn't work. So my investment advice is simple. Don't panic. Don't take on risk you don't need. Don't just keep your money in the market because your financial advisor is your church deacon and neighbor. There are plenty of safe options. Money markets, CDs, fixed annuities, and fixed index annuities, and so on, all protecting your principal. You already know it is enough to enjoy everything you want in retirement, all while getting you some dollars in the process too. But if you listen to the news, the Sunday commercials, the Fishers, the Edelmans, the Edward Jones, the Facebook ads, you may end up just like me in the summer of 1992, sitting at a picnic table, picking off the peanuts of your peanut butter parfait, wondering why you had to just cancel your annual Florida trip because you panicked when your financial advisor was rushing you through their very limited menu of risk, riskier, and riskiest investment options. I rest my case. Well, today we have Phil Huff joining us to help us out. How you doing, Phil?
Doing good, doing good.
I am excited. You're going to jump right in. We're going to start off with the myths and misconceptions section, which is one of our viewers' favorite segments of the show. And today we're going to jump in and talk about annuities. And we're going to talk about why people love them and why people hate them. And I think the myth is annuities are evil. What do you think about that? I mean, why such a reaction?
Yeah, no, it's definitely gets a visceral reaction of you either love them or you hate them. And a lot of it comes down to, like, does your advisor use them or not, right? If they use them, they probably love them and more than anything else. But I think at the core, like, are they negative? Are they evil? No, right? It's just another tool in the tool belt, and there's no right or wrong tool. It's just, what do you need? What plugs in for you the right way? So today, thought we'd break down a little bit of what are those misconceptions, how do they even work? Would be a good idea to talk to.
Well, I mean, when people talk about annuities, let's just start off with what are they? What is an annuity?
Yeah, so an annuity is a tax-deferred growth vehicle. And originally, I think where a lot of the misconception comes from is the original annuity was the pension, and that it just paid income, guaranteed income, but once you die, it's gone and all your money's gone with it. But the world's changed a lot, especially in the annuity space, that now it's just a safe place to grow money deferred.
Yep. And I think right now we're seeing some record-breaking numbers of people putting their money into annuities. Why do you think the big shift and change, I guess, kind of debunking this annuities are evil kind of comments? I know Susie Orman hates annuities, and you hear all this stuff, but yet people seem to be buying a lot of them.
Well, I think more and more people are starting to have them and like them. And they're telling their friends that they have them and they like them also. Because what happened is the market goes down and people now are nervous. They're nervous. They don't want to lose 20% again. So they're fleeing to safety. That's been a thing in the market forever. And, you know, in the past, it's been using things like CDs and savings accounts. But there's some better uses of that money through the fixed index annuity space.
Could you break down, now you just said fixed and fixed index annuity. Fixed index annuities are fairly new. Kind of, how do those work and how are they different than fixed annuities?
Yeah, so it has some components similar to the fixed side where you can just get a guaranteed rate of return, but they've got a little bit of flexibility with them also where, let's say you're confident the market's going to go up over time. You just don't know if it is right now. Well, this allows you to play into that where you can say, we want the upside of the market. So you participate in the upside to a certain level, but in that you've got zero downside. So you have that flexibility of, I want a pure fixed rate, or I want to have, you know, something in the market. I just don't want to participate in the downside.
And you mentioned tax treatment. Just, I know if you could quickly just kind of break down how the tax treatment works.
Yeah, this is a big one because a lot of people get into that comparison of the CDs versus annuities, and with annuities, they grow tax deferred, meaning you're not paying taxes on that growth every single year. It allows them to grow a lot faster. You know, compared to like a 4% annuity compared to a 4% CD, the annuity is going to outperform by almost 1% because you're not paying taxes as you go.
Well, Phil, it sounds like annuities aren't quite as evil as everyone thinks they are.
No, definitely not.
All right. Still more to come on Expedition Retirement, including viewer call-ins. Stay tuned.
You've spent your entire life climbing up retirement mountain, saving, investing, filling up those IRAs, and maybe working with a financial advisor. You made it to the top. Finally, your journey is over. But is it? The most dangerous part is just beginning. Getting down retirement mountain without running out of money is the real challenge. No more paychecks, just boulders tumbling towards your life savings. You need a guide, a plan to avoid the biggest nest egg killers: taxes, market risk, fees, and long-term care costs. You need a roadmap. And that's where we come in. At Golden Reserve, we'll build you a personalized roadmap to get you down retirement mountain safely, which includes 4 incredibly important tools. First, the tax map. Our CPA teams build a strategic tax plan, potentially saving you thousands of dollars. Next, get a true look at how much money can go backwards in the market with our market flashlight. Third, our fee filter. Uncover the thousands of dollars in unnecessary fees you may be paying to your advisor or investments each year. Fourth, skyrocketing long-term care costs means you need our long-term care compass. Our team of attorneys can help protect your house and other assets from a nursing home tragedy. So don't risk your retirement. If you want to make sure your life savings are protected and you've saved $250,000 or more for retirement, call us in the next 15 minutes and get a personalized roadmap for retirement. No charge, no obligation. Again, for your complimentary roadmap, call us at 614-683-3855. That's 614-683-3855 to visit any one of our 5 Columbus locations, including Dublin, Gahanna, Newark, Lancaster, and Delaware. Again, for those that have saved $250,000 or more for retirement, call us at 614-683-3855 or visit us online at getyourroadmap.com.
Welcome back to Expedition Retirement, and this is a great part of the show because we get to hear from you, the listeners and the viewers out there, and we want to hear what you want to know when it comes to your retirement. And today we have Debbie from Plain City with a question for Phil.
This is Debbie from Plain City. Everyone says to stay the course when it comes to investments and down markets. Should I keep my money in the market now, or is it different this time?
Gosh, 2002, we got this question a lot. What do you got? What advice do you have for Debbie?
Yeah, no, a lot of people are asking this question, and I think a lot of it stems from probably seeing the last decade, right? That you don't want to miss out. We totally understand that. You've seen the market double twice over the last 10, 12 years, so you don't want to be the one on the outside not making the decision to be in the market. And you're asking the question, right, is this time going to be different than last time? And really is like, what was last time, right? We know what the last 12 years have looked like. What about the 12 years before that? 2000 to 2011, right?
It was a little bumpy.
A little different.
A little bumpy.
In that if you had $1 million in the S&P in 2000, well, guess how much you have in 2012?
It was about half?
$1 million.
Yeah.
It was flat. It was dead flat. But if you're not retired and you're still working, you made money because you're buying in and you're buying in those waves. But it's different if you retired in 2000 because you're taking money out. And now you're taking money out in those down markets where, like, is this time going to be different? Who knows? What was the last really good decade?
If I'm hearing you, I think the bigger question is it worth the risk? Is it worth the risk to have some upside? Or put another way, is making another 20% going to change your retirement? But what about losing 40%, right?
Right.
I mean, how do you guide these conversations when people, feel that, the market's been roaring for the last 10 years, but then it turns around and loses, roughly 20% in 2022? How do you coach them through what's the right way to choose how much risk to take on?
Yeah. The first thing is understanding, like, what do you even need? What do you really want your money to do for you? What kind of life do you want to live in retirement? And when most of the folks that we talk to, they don't care about their portfolio or the stocks that they own personally. They just want to have a predictable retirement. And they feel like, because they've been trained this way by the industry, if they don't have all their money in stocks, bonds, mutual funds, that they're not going to make enough to make it.
They feel anxiety. They feel like they're going to run out of money if their money's not working for them. I mean, what do you have to say to Debbie and callers just like her, when it comes to choosing the right investments?
I mean, it's matched up with your lifestyle, right? Don't live a lifestyle that is conservative and where, you don't want to be over the moon with what you're doing in retirement. Have your portfolio match with what you want to do. And so much in this world, a lot of financial advisors, they plan to get you to retirement, and they're those high-risk portfolios, but you don't see that transition to when you're going down the mountain, right? Now when you're in retirement and you need your money, you've got to make that change as your life changes.
Well, I think that makes perfect sense. And, for all of you listeners and viewers at home, what we ask is that you start off with understanding what's at risk. And to do that, we use what we call a market flashlight, which shows you your exact amount at risk and how much your money could move backwards right now. And I think that's the place to start. So if you're interested in getting a complimentary market flashlight, which is part of each one of our roadmaps for retirement, you can go to getyourroadmap.com. That's getyourroadmap.com. Welcome back to Expedition Retirement. And we've been getting a lot of questions. Interest rates are on the rise, and people are kind of blowing the dust off some of those old investment types and saying, you know what? Should I get a CD? Should I get an annuity? What's the difference? So Phil, in breaking it down today, we're going to break down the difference between CDs and annuities. You ready?
Yeah, let's do it.
Let's jump in.
I'd say first let's hit a little bit on the similarities between the two, right? Both are termed investments, meaning you have them for a set amount of time. They have a fixed interest rate, and they offer principal protection. They're both safe investments. Your money's not going backwards. So in a lot of ways, at a core, they're very similar.
Because at the end of the day, principal protection is something that people are usually looking for in a market where they're retired and they're saying, you know what, I don't want my money to go backwards. So these two options are coming kind of out of the woodwork now because interest rates are getting up. We're seeing 4 or 5% interest rates now.
Right, yeah, and they're starting to close the gap on the market, right? So where people are like, okay, I'll 4 or 5%, I can live with that.
Yep. Now, I guess, how are they different? I mean, let's jump in and break down what's the difference between a CD and annuity.
Yeah, as much as they are similar, there are some key differences. And the first one, just the banking industry versus the insurance industry. I think this is important given some of the bank failures we've seen. Just know the insurance industry is a lot safer when it comes to what they have to have in their reserves. They're dollar for dollar. So your money's a lot safer with an insurance company. Also access, this is a big one because we're in retirement. Most people, it's when they want to spend their money. So a CD, a lot of people don't realize, is you can't take anything out. If you do, you're going to pay a penalty if it's inside that term period. So that's the benefit of the annuities side. A lot of them offering up to 10% liquidity every year.
So you can just take the money out whenever they want.
Take it out, go and spend it, spoil the grandkids, do all the things you want to do. So the access is a big one. Also tax treatment. This one's overlooked a lot, and it's how annuities are taxed differently. They're taxed by what's called tax deferred, meaning you don't pay every year. So Uncle Sam may hate that, but the fact that your money grows without getting taxed means it's going to grow a lot faster in a fixed annuity versus a CD.
Kind of like a Roth or something like that, or typical. The money is growing. They're getting interest on their interest before they're paying tax. They're paying tax.
Right.
Whereas with the CD, they're getting a 1099 every year, where the money has to come out of their CD.
Yep, compounding interest. It's
Okay.
the magic of money, right? And then also the flexibility. This is an added benefit for people that they think, I like the fixed idea, but I also want to participate in the market a little bit. You have some options where you can participate in the upside only, never the downside of the market, or just go with your straight line fixed return.
And I guess something that most people don't know about annuities, and I guess break down, you can change that option every year, unlike a CD that once you buy a rate,
Right.
that's the rate for the whole 10-year term. But
Yep.
with annuities, most of them, every year, that purchaser gets a chance to change.
Exactly, yep, every year, like you said.
Okay, that's fantastic. Well, this hopefully breaks down some of the main differences of some safer options in retirement. So when we come back here in a little bit, we're going to talk about the big question: how does the financial advisor get paid when they sell me my investments? If you're retired or planning to retire soon, you do not need someone to pick stocks. You do not need buzzwords or birthday cards. You do not need to pay 1%. You do not need a financial advisor. What you do need is someone to walk it with you.
Our in-house attorneys design legal plans that protect your assets from the nursing home, and our package covers the cost. That's how we walk it with you.
We help to make a trip or big purchase dream a reality. And unlike financial advisors, we don't take a pay cut when you spend your money. That's how we walk it with you.
We create and manage your IRA tax plan and tax returns, and our package covers those costs too. That's how we walk it with you.
You deserve a retirement plan that has real service and action that's priced the same for everyone, no matter how many zeros are in your bank account. You deserve a retirement planner that walks it with you.
Call us at 614-683-3855 to visit any one of our 5 Columbus locations.
Welcome back to Expedition Retirement. And we're going to talk a little bit now about that burning question on most retirees' minds, which is, how much does all this stuff cost? I know my financial advisor charges me something. I know my investments cost something, but I really have no idea what that is. So today we're going to start off by talking about performance, because that's how the tool spotlight usually comes back, right? Everyone wants to pull you back and get you talking about performance versus what things cost, right, Phil? I mean, do people ever say, here's what I charge, or do they say, here's what I'm going to return for you in the next coming years?
No, they're talking about this, right? Especially in the last 12 years where everyone was right, nobody was wrong. And I mean, don't get it wrong, they have to talk about performance over what it costs, because that's all that they have, is they're picking investments. So they have to have the extra charts and graphs to talk about it.
Well, and to me, it always is kind of interesting, because it doesn't really always tie to their retirement plan. It's always about, what percentage did I gain from last year? What percentage was the S&P up? What percentage was the NASDAQ up? And at the end of the day, why aren't they asking the right question? I mean, aren't they wondering, how much does this cost? How much does this performance really cost me to get this kind of wavy chart coming at me?
Yeah, I think that's a question that a lot of people have on their minds, but maybe doesn't come out to their advisor, right? And the thought is, oh, we've been making money, so I'm just going to let the cost kind of take care of itself. I really like my advisor. That'd be an awkward conversation, so I'm going to let that one go.
And it's easy to ignore that conversation if the market's up.
Right.
Because if we're getting a decent return, we just don't care as much if they're taking 1 or 2% off the top.
Right.
But when the market goes backwards like it did last year in 2022, I think people are saying, oh my gosh, the market went back 10%, but I lost 12%. Mm-hmm. Why?
Right.
I mean, do you see that come up a lot with your clients?
100%. The down years is when this hurts the most, right? Or even the even years, the years where you make 2 or 3, and that's when you start piecing together, wow, I'm actually being outperformed by the market every year when I look back at it. It's like, I guess they're not geniuses that are making every right pick. But yeah, no, the down years, that's when you see this cost come up a lot.
So for today's breakdown, I think what would help the viewers at home is let's just go through and figure out, when I get an investment, what does it really cost? How does my financial advisor get paid?
Yes.
You ready?
Ready.
All right, let's jump in. Let's talk about those safe investments, things like CDs and annuities. How does advisors get paid that use these tools?
Yeah, so with both of these tools, CDs and fixed annuities, the advisors is paid a commission by the companies. Now the beauty of it though is how the advisor gets paid is a commission, but how the client pays is they're not paying the ones that pay that commission. It's actually the companies that issue the CDs or the fixed annuities that are paying it out of their marketing budget in a way.
And I think that gets missed. I think putting it another way, when you go out and you buy a CD, and let's say there's a 1% commission on it, your account balance in that CD doesn't go back 1%. The bank already factors in that commission when they guarantee your 4% CD. And the same goes with annuities, right? So when an annuity, says, hey, you know what, this is a 4.5% annuity for the next 10 years. When they buy that, it doesn't come out of your money. And that's not the same regarding some other investments.
Right, especially, there's some of the percentage fee ones, but even a lot of the A share, B share mutual funds, those also pay a commission, but it's out of your money. That's the difference. The safe investments that pay commission does not come out of your money. The risk investments with commissions, they do.
Do you think that most people know that? Do you think most people at home understand that their money goes backwards with certain investment sales, whereas with other investment sales, it stays flat?
No, absolutely not, because there's a beautiful line that advisors use. You don't pay me anything. It comes out of the investments. And then it's left at that. Oh, I don't pay you anything for this. This is great. But it's coming out of your investment.
Oh, that's clever. Speaking of coming out of your investments, let's talk a little bit about managed money. We hear this AUM, assets under management, managed money, percentage fees. Walk us through kind of how that works and how a lot of systems are set up.
Yeah, this is how most financial advisors charge a percentage fee, somewhere between 1% and 2% to manage your money. So the idea of that is the more money you have, the more you pay, right? As your money grows, then that fee also increases. But we talked about that's the years that no one really cares or thinks about it. But when the years when we go down and we lose money, we still pay that 1 or 2% fee on the managed money model.
That makes sense. What about mutual funds?
So this is oftentimes in tandem. You get the old double dip where it's a managed account where you're paying 1% for the account as a whole, but the advisor then, because they don't want to be stock pickers, they buy mutual funds.
Yep.
And those mutual funds are the stock pickers where there's another fee, the double dip, where you could pay 1% to your advisor, 1% for your mutual funds. That's when fees really start to add up.
Wow. So I guess, Phil, walk us through, at Golden Reserve, we have a fee filter, and kind of walk the viewers, how does it work and why do people love it so much?
Yeah, this is the first step for everybody. Get an understanding of what you actually are paying and not just the percentages, right? The industry is great at just saying 1%, 2%, sounds like such a small number, but know the actual dollar amount that you're paying. So our fee filter is a tool that everyone gets with their roadmap where we look at your investments, your statements, and actually boil down to real hard dollars. What are you paying every year for your advisor? What are you paying every year for your investments?
In dollars.
In dollars.
So if you want your own fee filter for retirement, let us know. Go to getyourroadmap.com and we'll take your statements, put them in our fee filter, and show you what you are paying your financial advisor and for your investments. You just go to getyourroadmap.com. Phil, thank you so much for helping us today. You've been a huge help. I've learned a lot. Thanks again.
Yeah, thanks for having me.
Are you retired? Nervous about running out of money? Unclear if you have a plan for taxes and long-term care? Do you even know what you're paying your financial advisor? These are questions every retiree has, but seldom does the financial advisor ever have the answer. My name's Greg Aler, and I wrote the Amazon bestseller, Fire Your Financial Advisor. 40 years of greed and exploitation of the American retiree and how you can fight back. I wrote this book for my mom and dad, and folks just like them. They weren't multimillionaires. The other 95%ers, they had to work, earn, and save every penny. My book is a history lesson on how the financial industry took advantage of retirees and how we can fix it. Plus, I'm going to provide you with some material so that you can put emotions aside and figure out if you should fire your financial advisor. Just go to fireyourfinancialadvisor.com and put the promo code SHEEPDOG in, and you'll get 50% off your purchase. That's fireyourfinancialadvisor.com. Welcome back to Expedition Retirement, and we're going to wrap up today's show by talking about the roadmap for retirement. We've talked about some of these tools today, but we're going to summarize each of the 4 tools that coincide with 4 big risks in retirement: taxes, long-term care, fees, and the market. So to jump in, the first thing we're going to talk about is the taxes, right? Uncle Sam. No one wants to pay any more taxes than they have to, and that is what our tax map is for. Most likely in retirement, your number one liability is the taxes you owe on your IRA. Most people don't think about this, and most people use Uncle Sam's plan versus having a plan. That means they wait till 73 to take out the bare minimum as opposed to taking out on your terms. So to help do that, our team of CPAs builds a tax map that shows you when and how much to pull out of your IRA every year so you minimize the dollars Uncle Sam keeps and you can keep more money in your pocket for you and your family. Next up, we're going to talk about that market flash like we talked about that earlier in the show. We're going to show you exactly what happens if the stock market goes down. We're going to show you not just what percentage is at risk, but what you'd lose in real dollars if 2000 happens again, 2009 and 10, or 2022. Most people know they have some risk, but they don't know what that means in dollars. So this cranks that number out for you. Next, we do the fee filter. We just talked about the fee filter. This shows you exactly how much you're paying, not just your advisor, but what you're paying for your investments. And a lot of times people know the percentages, but when they see the actual dollar amounts, that could be $200,000 or $300,000 over the course of a retirement, it really puts them back in their chair. Last but not least, we're going to talk about the long-term care compass. And this is when we sit down with our estate planning and elder law attorneys in-house to build you a legal plan to address the largest risk in your retirement. That's going into a nursing home. We know you don't want to talk about it, but this could be $100,000 a year or more cost. So you need to have not just financial, but legal protection when it comes to your home and your life savings. And once we put these 4 tools together, folks, we get to build your income tent. We think about this as your permission slip because we show you what you spent last year, what you received, and then we project it out over the next 25 years. So we can show you that you're not going to run out of money. You should have more fun and spend more of your money. And we update this every year based on your spending. So it's an exciting tool that gets people spending and enjoying retirement, not staring at statements. Now, folks, that is our roadmap for retirement. If you want more information, go to getyourroadmap.com. Hey, it's all the time I have today. Thank you so much for watching Expedition Retirement. We can't wait to see you next week.
You've spent your entire life climbing up Retirement Mountain, saving, investing, filling up those IRAs, and maybe working with a financial advisor. You made it to the top. Finally, your journey is over. But is it? The most dangerous part is just beginning. Getting down Retirement Mountain without running out of money is the real challenge. No more paychecks, just boulders tumbling towards your life savings. You need a guide, a plan to avoid the biggest nest egg killers: taxes, market risk, fees, and long-term care costs. You need a roadmap. And that's where we come in. At Golden Reserve, we'll build you a personalized roadmap to get you down Retirement Mountain safely, which includes 4 incredibly important tools. First, the tax map. Our CPA teams build a strategic tax plan, potentially saving you thousands of dollars. Next, get a true look at how much money can go backwards in the market with our market flashlight. Third, our fee filter. Uncover the thousands of dollars in unnecessary fees you may be paying to your advisor or investments each year. Fourth, skyrocketing long-term care costs means you need our long-term care compass. Our team of attorneys can help protect your house and other assets from a nursing home tragedy. So don't risk your retirement. If you want to make sure your life savings are protected and you've saved $250,000 or more for retirement, call us in the next 15 minutes and get a personalized roadmap for retirement. Again, for your complimentary roadmap, call us at 614-683-3855 to visit any one of our 5 Columbus locations, including Dublin, Gahanna, Newark, Lancaster, and Delaware. Again, for those that have saved $250,000 or more for retirement, call us at 614-683-3855.